How does this cycle compare to the 0709 cycle to this one?
Yeah, and actually, I've been through more than two cycles. I've been through two cycles in this type of investing, but I got into this type of investing because of literally as a reaction to and as a result of the previous cycle to that, the dot-com crash. That's actually what got me looking at this space. So what I would say for this cycle is very interesting because it's not, first thing I'll say is that the big difference is that we have had a proper crash. And the media has never, I've never seen anyone use that word. And I've decided to use it every podcast I'm on now, because that's actually what it is. And I want to make sure anyone who's new understands that. Most of our asset classes are down 20 to 30%. And it's even worse than a crash, because if you have a crash in the stock market at 20 to 30%, you've lost 20 to 30% of your money if you don't use leverage, right? Which most people don't. If you have a crash with 20 to 30% in this type of investing, you've lost most or all of your money as equity. So it's a proper crash that's impacting a lot of people. Obviously, with real estate, it's different in that you don't lose the money unless you sell, theoretically, but there's all kinds of challenges occurring with capital calls, stoppages of cash flow, some foreclosures, some loan workouts, and all kinds of stuff that's happening. I would say that this time, most of the society doesn't realize this is happening. It's not really covered very widely in the media. I think there was a little bit of coverage about office having a problem earlier this year. I've seen the odd article or two about accredited investors being impacted by apartments, but it's impacting accredited investors in a very big way, the non-institutional investors. The last cycle was much more overt, at least in its entirety, in that it was very obvious that a lot of people were just mom and pops were impacted by single family homes going down, whether they own homes and lived in them or whether they were trying to flip them, because it became a very common thing for a lot of people to get involved who weren't normal investors. So the media is not really covering this one. Now, that being said, I believe that we've only seen one of two dominoes fall so far. I think we've seen the interest rate domino fall, so that this is what caused the initial adjustment in pricing. But I think we still have a recession domino to fall. That's my opinion from a probability scenario. And that's when the mainstream media will catch up. And that's probably when the stock market just traditionally takes another leg down, starts to impact a lot more people, and people really pay more attention. I don't think that we're still going to have too much coverage in the media about this. So I think it'll still be more hidden that this crash occurred on this side of things. But I am expecting the media is going to catch up to what's going on here next year, which is when I think the highest probability scenario is of a recession. So it's a very different scenario so far. But to be fair, Dennis, like I think we're in the bottom of the first inning with all this, and not much further than that. And so as it relates to our type of investing. And so I think we have a ways to go still to see how it all ends up being similar or different to the last cycle.